Good morning, Chris with OptionMillionaires.com with a morning analysis video on some macroeconomics. First, with Apple, I just want to point out that today or yesterday's action is going to give us a signal that we would say, as a technician, would be a channel breakdown signal, or perhaps even a rising wedge. So we see we're going to break through the bottom part of this channel, so that means we have an active price target on Apple right now at sitting around $550. So right now it's at about 570. So if you want to play that one, go ahead. Time frame, I don't know. I'm sure that Jimmy Bob or UPB is already thinking of some kind of trade like with Win, where they're going to turn $2,000 into $10,000 in a matter of minutes. But my trades are a little longer time frame. So I want to address the question why QE3 is not going to happen soon. So QE3, every single time that the market goes down, every single time that we see the Dow drop, suddenly it rebounds a little bit, and it's because people think there's going to be some hope of QE3. Like, even if I jump on the internet right now, there was an article yesterday toward the end of the day in the market. The Dow was down over 200 points, and then sure enough, some article comes in the Wall Street Journal, and before you know it, by the end of the day, we're off to the races. So if I actually go to the article, hang on. Okay, I just got this one from Fox Business, but you see right here, Federal Reserve officials are moving closer to taking new action, according to the Wall Street Journal. So they say it's because they're growing impatient with high employment and sluggish growth. Well, you have to remember that the Fed, even though we tend not to think about it, we only think of one reason for the Fed. The Fed has a dual mandate, and their dual mandate, they have two responsibilities. Number one is to achieve price stability, and number two is to stimulate the economy when necessary. So the one that everyone only cares about is stimulate economy, but their real mission and what they were actually made to do back in the early 1900s was to keep price stability. It was right after World War II, when we just had a huge inflationary period. So this is something that they look at is inflation expectations. So you have inflation expectations, which actually leads inflation. And the best way that we can actually see inflation expectations would just be simply the TIPS fund. So you can look at like the news and like watch corn prices and oil prices, all that stuff. But it's better just to use the TIPS fund, because that'll give you an aggregate estimate. So we have the TIPS fund, which is basically the 10-year TIP bond, and then we have, let's go with IEF, and this is going to give us a 7 to 10-year Treasury bond. And what I'm going to do is I'm going to plot a ratio of the two. And now we have my move out. I already have my drawings on here. So you see that when this ratio gets above a certain level, like say 1.17, that's when we start panicking. That's when we start building bubbles. Inflation gets pretty darn bad. But remember, this is just expectations, but expectations can create inflation in themselves. So we see here that in the recent times, the Fed does not like getting the TIPS outperforming the Treasury bonds by this much. So they only do QE3 when we're actually very bearish on inflation. We think that we're close to deflation. So this was where we had QE1 right here. This is where we had QE2 right here. And each time we stopped when it hit this level. You think they're going to have QE3 right here? How much do we have to actually, time before it once again hits this level and they have to pull the plug again? It's not going to work. So QE3, until this line gets down here again, and people are suddenly expecting deflation, Fed's not going to do anything else. They can't, because if they do something now, you're going to have runaway inflation right away, or at least inflation expectations. And who can we thank to this? We can thank oil, we can thank corn, we can thank Iran, we can thank a bunch of people. But as long as that ratio stays down, Fed's not going to touch a thing.